Brad Williams, Frugal Finance. Let's briefly talk about a strip hedge. The stack hedge of the previous example was really hedging against the change in December future yield because all of the contracts were stacked on that single future expiration. Instead of using a concentration of contracts on a single expiration, a strip hedge uses an equal number of contracts for each future's expiration over the hedging horizon. Our example of a 100 million financing requirement at a risk for 3 quarters, we have seen that a Eurodollar hedge requires 300 contracts in a strip hedge. The construction company would sell 100 Eurodollar contracts each of the December, March, and June futures. With the strip hedge in place, each quarter of the coming year is hedged against shifts in interest rates for that quarter. To illustrate the effectiveness of the strip hedge for an unequal increase in rates, Table 615 shows the results of the construction firm example. The strip hedge of Table 615 works perfectly. The superior performance of the strip hedge results from aligning the futures market hedge with the actual risk exposure of the construction firm. Because the construction firm faced interest rate adjustments each quarter, it needed to hedge the interest rate risk associated with each quarter. This can be done through a strip hedge, but not through a stack hedge. Strip versus stack hedges. From the example of the strip hedge, it appears that a strip hedge will always be superior to a stack hedge. While there are many circumstances in which a strip hedge would be preferred, it's not always better than a stack hedge. The important point is to use a strip or stack hedge as required to match the timing of the futures hedge to the timing of the cash market exposure. There's also a practical consideration that often leads hedgers to use a stack hedge when theory might favor a strip hedge. To implement a strip hedge requires trading more distant contracts. In our example, the construction firm traded the nearby second and third contracts. There's always sufficient volume and liquidity in distant contracts to make such a strategy viable. Strips work well with Eurodollar futures because Eurodollar futures now have sufficient volume in distant contracts to make them attractive. This has not always been the case, however. When distant contracts lack liquidity, the hedger must trade off the advantage of the strip hedge with the potential lack of liquidity in the distant contract. Also have to keep that in mind, all right? For the dominant interest rate futures contract, strips work well because of the greater liquidity in these markets. So here's the example, the result of the strip hedge. We got the cash market and the futures market. You borrow 100 at 9 for 3 months and commit to roll over the loan for 3 quarters at 200 basis points over the prevailing SOFR rate. Sell 100 Eurodollar futures for each December, March, June. Pay interest. SOFR is at 7.4. Borrow 100 million for 3 months at 9.4. Offset 100 Eurodollar futures at 99.20, produce profit of 25 grand equals 10 basis points times 25, etc. Pay interest on 2.3 million at 10.3%. Offset 200 March Euro futures at 91.70, produces a profit of 175. Pay interest at 2.75, borrow 100 million at 10.6. Pay interest of 2.6 in principal 100 million, offset 100 June Euro futures at 91.40, produce a profit of 175, 70 basis points times 25. Your interest expense 9.8, futures profit 375, net interest expense 9.45. So you accomplished your initial goal. Brad Williams, Frugal Finance. See you soon.